Imagine the U.S. economy as a massive jetliner cruising at high altitude, powered not by just two engines as we once imagined Europe, but by a complex array of economic forces, a robust labor market, steady consumer spending, technological innovation, abundant capital inflows, and a global appetite for American financial assets. At the cockpit sits the Federal Reserve, acting as both pilot and navigator, adjusting the thrust of the entire economy using one crucial control: interest rates. For much of the past 2 years, this jetliner has faced extremely turbulent skies. Global shocks, a pandemic that grounded entire fleets of businesses, and massive fiscal stimulus that refueled markets midair have all tested the limits of monetary policy. Yet here we are, at the end of another year, with the United States economy proving surprisingly resilient. Inflation soared at one point, then receded, employment remained strong, consumer confidence held steady, and through it all, the Fed wrestled with finding the right altitude and speed. Recently, the Federal Reserve decided to cut its policy interest rate yet again. This marks a total of 100 basis points of easing since it started lowering rates earlier in the year. But why cut now? Inflation is still above the 2% target, growth is sturdy, and unemployment remains low. It seems counterintuitive at first, prompting investors, analysts, and ordinary citizens to ask what the Fed's true intentions and expectations are. To understand this, we need to recall where we came from. Just a year or two ago, the U.S. faced some of the highest inflation in decades. The Fed responded by raising rates aggressively to cool the economy, calm overheated markets, and bring price stability back into the picture. These hikes worked overtime, cooling demand and gradually reining in inflation. By late 2024, inflation had fallen from above 5% to near 2.8%. Not perfect, but a remarkable improvement that allowed the Fed to breathe a bit easier. Yet the fight isn't over. The Fed's official goal is 2% inflation. Getting from 2.8% down to 2% could prove trickier than expected. The labor market, while cooler than before, remains tight enough to keep wages growing. Consumer spending is steady. Growth is running above what many predicted. The Fed doesn't want to break too hard and risk a needless downturn. It wants to find the neutral rate, the interest level that neither boosts nor restrains growth. It has already cut by a full percentage point this year, bringing rates closer to, but still above, what might be neutral. Now comes the delicate part. By edging rates slightly lower again, the Fed signals that it believes current policy is still restrictive enough to guide inflation downward, but that it doesn't need to slam the brakes any further. Moving slowly towards neutral gives the Fed optionality. If inflation edges down steadily, they can afford to pause or cut more gradually. If it flares up again, they can stop cutting and hold rates steady. The latest projections show that policymakers now anticipate fewer cuts next year than previously thought. In other words, the door to continued easy money is not wide open. The Fed is saying, yes, we can adjust policy, but we will do so cautiously. The reaction in financial markets was swift. Instead of applauding the new rate cut with rallying stock prices and stable bond yields, investors seemed rattled. The dollar strengthened, yields rose, equities slumped. This might seem odd. Lower rates often mean cheaper borrowing and more optimism. But here, the message was not simply, the Fed is cutting. It was, the Fed is cutting, but watch out. We're not sure how much more we'll do. Uncertainty breeds caution. Markets crave clarity and got complexity instead. Thinking back to Europe, where we once drew analogies of an airplane with two main engines, Germany and France, both facing trouble, we saw how delicate balance can be. In Europe's case, if the core economies stumble, the entire continent feels it. In the US, you have a powerhouse economy, more like a jumbo jet with multiple engines. Even if one source of growth falters, another might pick up the slack, but that also means managing all those engines is tricky. The Fed's job is complicated further by looming policy changes under a new administration. Nobody knows how proposed tariffs, fiscal expansions, immigration reforms, or shifts in regulation might affect inflation next year or in 2026. Some participants in the Fed's internal debates have started, even if only slightly, to factor in the possibility of policy changes that could drive inflation up or down. Tariffs might push consumer prices higher, making the Fed's job harder. On the other hand, more immigration could alleviate labor shortages, reducing wage pressures and helping inflation settle lower. The Fed, for now, is driving through fog. It is aware that turning too quickly or accelerating too fast in these unclear conditions might lead to trouble. Thus, a measured approach, a modest cut now, combined with cautionary language that hints at potential pauses down the line. This approach acknowledges that while progress on inflation has been good, it's not guaranteed. After all, inflation's path has proven more volatile and stubborn than expected, and global factors like commodity prices or geopolitical risks could reintroduce volatility at any time. One might wonder why even cut now? The Fed's reasoning could be that after a year of tighter policy, pushing against economic growth and investment, it's now close enough to neutral to afford a small move. This helps keep the economy stable, ensuring the labor market doesn't weaken drastically, and it preserves enough flexibility for next year. If inflation accelerates, the Fed can pause and wait. If inflation continues to drop, it can cut further. They want to avoid a scenario where policy is so restrictive that it becomes a headwind, forcing the economy into a downturn that might not be necessary. Meanwhile, financial conditions have not loosened as much as the Fed might have expected given rate cuts. Mortgage and corporate borrowing costs remain relatively high. Equity market breadth weakened noticeably, and the initial market reaction to the Fed's decision suggests lingering doubts. Instead of cheering easy money, investors fretted about the Fed's complicated balancing act. To broaden the lens, this U.S. scenario affects the entire global economy. When the Fed adjusts its policy, the dollar moves and emerging markets tremble. Capital flows can reverse, putting pressure on currencies, yields, and growth in other countries. Europe, still grappling with its own slowdowns and not yet at cruising altitude, watches closely. If the U.S. remains strong but uncertain, the euro might weaken, European exporters might struggle, and confidence could erode further. The Fed's moves also set a precedent. If the world's largest economy and its central bank are struggling to be sure about inflation, growth, and policy, what does that say about everyone else? Global financial markets trade in signals, expectations, and assumptions. Uncertainty at the Fed translates into more careful risk-taking everywhere else. Some may argue that the Fed should have been clearer. Maybe it should have paused altogether this time and waited for more data. Others might say that calibrating policy in real time is inherently messy, and that by making a small cut now, the Fed keeps all options open. The truth probably lies somewhere in between. The Fed operates in a world of incomplete information, asymmetric risks, and political crosswinds. What do you think? Is the Fed's cautious cut the right move? Should it have waited and seen more data? Are the markets overreacting to the slightest hint of uncertainty? Let me know your thoughts. And if you find these deep dives helpful, consider liking this video and subscribing for more in-depth discussions on economics, markets, and global financial trends. Thank you for watching. Stay curious, stay informed, and stay prepared as we navigate the ever-changing skies of the global economy.